how concerned should the average American be in regards to their employment next year and their real wages?
Yeah, when you look back at the history of recessions, right before the recession, um, there's a chorus saying that soft landing is the most likely outcome. That happened on the eve of the 2000 to 2001 recession. That happened right before 2007. In fact, 2 months before the 2007 Great Recession, Janet Yellen herself says that the most likely outcome is soft landing.
But all in all, no, I know that it's hard to believe this, given kind of some of the media hype about how terrible things are. On balance, real wages are an all-time record high. Employment is at an all-time record high. Maybe I'm just too much of a macroeconomist, and looking at the data, right now it all looks pretty good. Obviously, if Anna's right, it's not going to look very good, but that's not my forecast.
The very important discussion as to whether the economy will get a hard landing or a soft one rages on. This debate affects us all, and we'll be having this debate today with two esteemed economists, Dr. Ed Yardeni and Anna Wong. Ed Yardeni is the president of Yardeni Resesarch. He previously served as chief investment strategist of Oak Associates, Prudential Equity Group, and Deutsche Bank's U.S. Equities division in New York. Dr. Ed taught at Columbia University's Graduate School of Business and was an economist with the Federal Reserve Bank of New York. You can find his work at Yardeni Quick Takes. Anna Wong is the chief U.S. economist for Bloomberg Economics. She was previously principal economist with the Federal Reserve Board, chief international economist of the Council of Economic Advisors of the White House, and economist at the U.S. Treasury. Anna obtained her PhD in economics at the University of Chicago. Dr. Ed and Anna, welcome. I've had the privilege of hosting both of you separately, and it's an honor today to be bringing together two great minds in this bull versus bear debate. Thank you for being here.
Thank you.
So I'll start by asking the same question to both of you. Anna, ladies first, I guess. Are we going to get a hard landing, a soft landing, or no landing by the end of the year?
So our base case is still for a recession. So in other words, hard landing. Let's be clear about the definition of soft landing versus hard landing. So when I say our base case is hard landing, I pretty much means that the Psalms rule would be satisfied before the end of the year. So the Psalms rule say that as long as the unemployment rate rise by 0.5 percentage points and a moving 3-month average higher than the minimum of the past 12 months, then you'll get a recession. And all we need is for the unemployment rate to jump to at least 4% in the next couple of months before the end of the year to trigger this rule that has successfully identified recession since the 1970s. So I think there are the top three reasons for why we remain in our forecast a hard landing baseline is that number one, most recessions are caused by the Fed, and in fact, if you look at the history of recessions, the top two culprits for them are either the Fed rate hikes or oil price surge. And we happen to have both of them right now. So let's talk about the Fed rate hikes first. So we had seen 525 bips of rate hikes since March of last year. Milton Friedman said that the impact of monetary policy has long and variable lags. But I think the part that a lot of soft landing optimists focus on today are the shorter lags of monetary policy. Our view is that monetary policy has variable lags even within the same cycle. So I do agree with the soft landing advocates that the lags on financial conditions, on stock markets, on housing markets, on manufacturing are pretty short, and that's why we're seeing reacceleration in many of these areas. However, according to our models and our, looking at the economy from various different ways, we still think that the lags on the labor market remain to be long, so pretty much 18 to 24 months lag, which means that the maximum impact from the rate hike should be hitting right around towards the end of this year or early next year. Second, when we look at the Fed forecast, so last week we saw the updated projections from the Fed, and it shows that they believe unemployment rate would only be 3.8% towards the end of that later this year, which is consistent with a soft landing forecast. Well, that is also consistent with a linear mean forecast of the future that's backward looking. And what we have found is that even though if we use the traditional tool sets that economists have to forecast the future, it will give you a 3.8 or 3.9 unemployment rate forecast in the near term. But the risks around that mean forecast is actually asymmetrically skewed to the upside just based on the historical distribution of unemployment rate. And that's because unemployment rate follows a nonlinear process. And the reason why it's very hard to forecast recession is because, number one, recessions happen very rarely. And number two, recessions are always due to a combination of shocks, right? And when those shocks hit, the unemployment rate rise non-linearly. And so all of these mean forecasts tend to not be able to forecast sharp jumps in unemployment. So what we are seeing at the current moment of the economy indeed is that combination of shocks. So I see at least 5 shocks in the horizon. Number one, the UAW strikes. We estimate that if it goes on for the entire quarter, it can shave off as much as 0.6 percentage point of Q4 growth. We also, second, we have the student loan repayments. It could shave off at least 0.1 to 0.5 percentage point from Q4 growth. We have government shutdown, which if it lasts for a month, it could shave off 0.8 percentage point from GDP. We also have the oil shock, which could shave off 0.3 percentage point from GDP. So altogether, it's very easy to come up with a GDP growth number for the fourth quarter that's negative, and also for the unemployment rate to jump to 4% or above, which would trigger the Psalms rule. So I think all in all, our baseline is still that recession is the most likely case.
Okay, thank you. We'll come back to some of your points later. Dr. Ed, same question to you first. Hard landing, soft landing, or no landing?
Well, David, Anna, you both know that this has been the most widely anticipated recession of all times. Really, since the Fed started raising interest rates early last year, as it became obvious that they were going to be more aggressive because they realized they'd fallen behind the inflation curve and they were scrambling to catch up to it. So they increased interest rates dramatically. And early on, we saw mortgage rates soar, not just because the bond yield went up, but also because the spread with the bond yield widened. And that was because the Fed made it fairly clear that they wanted to get out of the mortgage finance business. They wanted to basically get out of their mortgage securities. And so it was widely anticipated that this would all lead to a recession fairly quickly, and it just didn't happen. It was sort of the Godot recession. I'm not saying it isn't going to finally show up, and I agree with Anna. I mean, you could certainly add up all these near-term, short-term problems with the UAW strike, with the possible government shutdown, with a spike up in inflation, and a few others that Anna mentioned, that could very well give us a negative fourth quarter real GDP. But then I think if that's the case, I think it would rebound pretty nicely in the first quarter. I don't think it would track as an official recession. I don't think that the equity market would view it that way, and I'm not even convinced that earnings would be that hard hit in that kind of situation. So I think it would widely be perceived as being related to, dare I use the word, transitory. So any downturn would be viewed as probably transitory, where the economy would rebound. I've been actually arguing that the economy has been in a recession since the beginning of last year. Now, some of you may say, huh? Didn't Yardeni just say that he's been looking for the economy to continue to grow? I've been adding an adjective to that. I've been saying that we're in a rolling recession, otherwise known as a mid-cycle slowdown, a growth recession. The rolling recession idea, I think, so far has worked out pretty well. We've had a housing recession However, let's be exact here. We've had a recession in single-family housing starts. Multifamily has held up remarkably well until August. In August, we saw multifamily take a dive. So maybe the rolling recession is about to roll into multifamilies, while I see evidence that the single-family recession is actually bottoming out. In 2021, we had a recession in retailing in the goods sector of the economy, and it's continued into 2022. And the question is, why didn't that add up to an economy-wide recession? The answer is consumers pivoted from goods to services, and that held up the economy quite well. During the lockdowns, maybe that kept us all from getting COVID, but we all got cabin fever. And so when the lockdowns were lifted, we just needed something good to happen. So Americans are wonderful. When we're happy, we go shopping. When we're depressed, we go shopping. So we went shopping. We wanted to release that dopamine in our brain to make us feel better, and it worked. The only problem is we really couldn't buy services. All we could really do was go on a buying binge for goods. Retailers ran out of inventories in a matter of months and ordered a whole bunch more. They got jammed up in the ports in LA and got stuck with not enough trucks. And by the time it all arrived at the retailers, consumers had said, I'm going on vacation. I'm not interested in buying any more goods. And so there's been a retailing recession. And I think there's evidence that may be bottoming. We're seeing the manufacturers' purchasing managers index showing signs of picking up. Undoubtedly, the recession is now rolling into commercial real estate, and that could be a very long recession in that particular sector. It's not just old urban office buildings. It's everything that was financed at near record low or record low interest rates back in 2020 and 2021, as some of that has to be refinanced or some of that is tied to adjustable rates. The math just isn't going to work on a lot of these properties, and there are going to be delinquencies. They're going to be failures, and I think the financial markets will handle it pretty well. We've got a whole industry of money managers who have money to deal with distressed assets. They actually welcome an environment where they can get assets cheap and then use their funds to turn these things around. And so I think that'll keep the situation from becoming a serious problem. Look, the yield curve has been forecasting a recession for a long time. The index of leading indicators have been forecasting a recession for a long time. The inverted yield curve is actually one of the components of the index of leading economic indicators. I think the reason it hasn't worked is if you look at the year-over-year percent change in leading economic indicators, it's almost a perfect fit with the manufacturing purchasing managers index. In other words, the leading index is very biased towards manufacturing, towards goods. And I've pointed out that the goods economy has been in a recession. It's been a growth recession. It's, if you look at consumer spending for consumer goods, they've been flat. They haven't been taking a dive, but the services has continued to grow. So I look at the consumer. I don't think you get a recession without the consumer halting spending. The consumer is just too big. And you don't get a consumer recession without major layoffs. And we all see that initial unemployment claims through the latest week available have actually been lower, closer to 200,000 than 250,000. We've got record construction employment. We've got record employment in restaurants. So I don't think that's going to change. I think the labor market will continue to create gains for consumer incomes, and real wages will increase.
Okay. And could you just respond to the last point? Well, I'll let you respond to anything else you like, but Dr. Ed made the point that the labor market will continue to add real wage increases and provide consumer with the wealth and power to spend. Can you respond to that?
Yeah. So first on the consumer resilience. So, so a lot of the points that Dr. Ed Yardeni just mentioned, I actually agreed. First of all, I think that once NBER Business Cycle Dating Committee has all the data, a couple of years later, they would probably go back and think that maybe middle of last year, could have been the beginning of a recession, because actually a lot of indicators would say that mid last year was actually the cyclical peak. But on the consumer, let me quickly talk about that. So we did look at consumption changes in the pattern of consumption before previous recessions. And what stands out is that, as Dr. Yardeni said, American consumers spend whenever they could, even in bad times. As long as you give them a credit card, they will spend. And so, in fact, consumption is not a good indicator for recession, because it especially services consumption, it barely decrease on average in most. Granted, each recession in the past has had a different characteristic to it, but for most of them, consumption in services does not really tank. What does tank in the consumption is durable goods consumption, such as purchases of cars and purchases of house, and that's because those particular consumption categories are sensitive to interest rates, which gets back to my story, my original claim that usually it is the Fed who murders any kind of expansion. So I would say that looking at consumption resilience as a predictor of recession wouldn't give you a very good read of what will happen next. But that said, I do see signs that the American household is retrenching in spending. We expect that retail and spending indicators in the next couple months would be quite negative, particularly because, number one, when we look at excess savings, we saw that 80% of the household, once you adjust the cash liquid holdings of their in their bank account by inflation, they're actually less well off than in 2019. So in the past 2 years, that kind of the cash they have in the bank has been fueling and bolstering the consumption. And from now on out, they have to rely on borrowing. And with credit card interest rate now at high 20s, even for people with very good credit, it becomes harder and harder to sustain this. And this is why we are seeing a surge in delinquency rates for auto loans, credit card loans. And when we project out these delinquency rates, it looks like by the end of this year, the delinquency rates would reach the level of 2010. So that's number one. Second, on the point that manufacturing has been bottoming out, I would have to say there are signs, there's indicators that I put more weight and less weight on in our recession baseline, and the indicators that we have not really been factoring or putting a lot of weight on are exactly the yield curves and also the manufacturing sector, as Dr. Yardeni said, because number one, the inversion of yield curve, while it had accurately predicted recessions in the past, we do think that that signal has been contaminated by quantitative easing, which reduced the term premium. So it's just easier to invert a yield curve nowadays. So that actually factor very little in our recession call. Number two, on manufacturing. In the past, manufacturing sector has been a key contributor to recession, just because even though it's a smaller share of the economy, it is very, very volatile, and it has driven recessions. So as I was saying, the lags of monetary policy actually predicts that the lags on the manufacturing sector would be quite short. And so when we when we estimate the lags of monetary policy on all the variables in the economy, where the manufacturing sector stands right now, this reacceleration we're seeing is precisely predicted by the model. What the model is saying is that we still have yet to see the lags on credit markets. And the reason why going back to consumers, that consumers can continue spending is because they can borrow. Now they have to increasingly rely on borrow, while firms are putting more in capex because they can borrow as well. But as the balance sheet normalized, they will rely more and more on borrowing. And with rates this high, this is where the lags on monetary policy will still hit.
Dr. Ed, I'll just let you respond to that before we move on to the next topic.
Yeah, I think there are a number of important points I'd like to add. One is, the index of coincident economic indicators. It has four components to it. It's got payroll and real incomes. It's got industrial production, and it's got real business spending. It also tends to be kind of biased towards goods, but historically, it's peaked when the economy's peaked. When as Anna said, after a year or two, when they look at the data, they conclude that the coincident indicator peaked. It's come down, and they declare that there was a recession. I don't really think we even need the committee. I can do it at home for free. Anybody can do it at home. This is one thing you can actually try at home. Just look at the monthly index of coincident economic indicators and judge for yourself. It's at an all-time record high. If it was, if it had peaked a few months ago and it was coming down, I would concede that we're starting to see signs that the economy is caving in and falling into recession. It's true that the history shows that the Fed kills economic expansions. They recognize that the boom has turned inflationary and they raise interest rates. But one of the reasons the yield curve inverts is because there is a perception that if the Fed continues to raise interest rates, something will break in the credit system. There'll be a financial crisis. And the inverted yield curve has been spot on right again. There was a banking crisis back in March, but what is different this time, I know that's a jinx sometimes to say that, but undoubtedly what's different this time is the Fed came in and whacked that mold. The Fed played whack-a-mole back in 2008, 2009, with the great financial crisis, creating all sorts of liquidity facilities. It did it again during the great virus crisis with great success. And as soon as the banking crisis broke out in March, it again created a liquidity facility that stabilized the financial system. So the inverted yield curve really doesn't forecast recessions. It forecasts a process that leads to recessions. It forecasts that if the Fed continues to raise rates, something will break in the financial system, that will in turn become an economy-wide credit crunch where even good borrowers won't be able to borrow. And that in turn is what causes a recession. So far, we haven't had an economy-wide credit crunch. Credit still remains available. I don't think the consumer needs to borrow to spend. I think the consumer needs jobs and real income, real wages in order to spend. That's what really drives consumers historically. It's increases in real disposable income, and real disposable income is increasing. I also take issue with the widely held notion that the consumers had all this excess saving that they spent, and that's all gone, and now all of a sudden they're going to have to slam on the brakes because they got no more money left. I would point out that at the end of the second quarter, the household sector had record net worth of I think it was $157 trillion. And the baby boomers had half of that, $77 trillion. I'd say that's the real excess savings. Maybe I have an advantage over younger folks like Anna. I'm a baby boomer, and there's 75 million people like me. And I'm not retiring, but a lot of my friends are retiring. And they're now asking them the question. The question is, what do we save all that money for retirement? What are we supposed to do with it? And they're making a decision. How much are they saving for precautionary purposes, like they might live longer than they expected and might not be in good health? How much to leave the kids and how much to spend on themselves? What I see, and maybe I live in in a neighborhood where this is uncommon, but I see a lot of baby boomers spending the money that they got saved for retirement. Some of them are forced to take money out of their 401ks. All of them are required to, I think at the age of 70, you're required to start taking money out of your 401k. So what I see is a lot of retiring baby boomers going out to dinner and lunch and breakfast. The kids aren't home anymore, so what's the point of cooking anything at home? They're going on spending sprees on services, and they're spending lots of money in healthcare, which is another area where we have record employment. The other thing that I think is important to recognize is that fiscal stimulus is remarkably stimulative. The Biden's stimulus packages were passed last year for infrastructure and so-called Green New Deals that spending is still ahead of us. Meanwhile, onshoring has really taken off. Manufacturing facilities, construction is absolutely booming. That explains why construction employment is at an all-time record high. How could that be at a record high with a housing recession? Well, because we don't really have a housing recession. We have a single-family housing recession. So there's a lot of moving parts here. It's not that it's pretty complicated, and I think you got to look at all these parts and decide their importance. And the way I see it is it adds up to an economy that's resilient, continues to grow. I think it's going to slow down relative to the third quarter. And you could have a negative fourth quarter, but I think next year is going to be kind of a 2% growing economy. And if I'm wrong about that, I think it'll be because productivity really takes off, and that'll be the surprise on the upside.
Okay, Anna, I'd just like to move on to the next segment, which is market implications. So you mentioned, Anna, a few potential shocks to the economy, the UAW strike being one of them, student loan repayment, government shutdown, oil shocks, all happening potentially in the fourth quarter, making the quarter negative in growth. What would this mean for the U.S. equity markets?
Well, first of all, I'm not a equity strategist, so
Okay.
I would just come at this from a more macro perspective.
Sure.
So from a macro perspective, I think equities does very poorly with uncertainty and volatility, right? So when you have all these shocks that I mentioned hitting at the same time, and at the same time that there's a government shutdown, which means that all these economic data releases would be delayed and postponed. Basically, we will have a month of October where a lot of bad things are happening at the same time, but there will be no data coming out from any official institutions, and it's times like this where I think leads to a lot of rumors, a lot of, I think a good analog would be in China, for example, where people have doubts about official statistics. When they stop publishing data, there's just a lot of rumors going around, and that is generally not a positive thing for, for I think stock markets. So second, if a recession does unfold as our baseline says, then obviously recessions would be bad for equities.
Okay, so Dr. Ed, two-part question for you. Do you think the higher oil price is going to weigh down on the equity markets? And then second part, more generally, what is your outlook?
Well, the equity market does have energy stocks in it, and those stocks have done and will continue to do very well if the price of oil just stays here. I don't think the price of oil is going to sustainably go up to $100 to $120 a barrel. It's the Saudis have got to recognize that if the oil price goes up too high, that will in fact cause a global recession. As Anna pointed out, recessions have occurred after we've seen sharp increases in interest rates and sharp increases in oil prices. So she's right, that is a concern. But I think the price of oil is peaking right around now. I don't think it's going to keep going higher. I think you're going to see some demand destruction. People are going to buy less gasoline around the world. I think you're going to see some non-OPEC production really pick up in response to this great incentive with higher prices. So it's not all negative news for the stock market to have energy prices going up. Having said that, I at the beginning of this year predicted that we get to 4,600 on the S&P 500 by the end of the year. We got there at the end of July, so we got there ahead of schedule. And I concluded that maybe the first half would turn out to be a better time for the stock market than the second half. And we all know about the September and October months being sometimes challenging for the market. But I think there will be a year-end rally. I think we'll get through the short-term issues of the government shutdown. The government will open up again. If it does shut down, the UAW strike will be resolved. So I don't think these things are long-lasting. And I think there will be a peak in oil prices. And I think we'll even find that the bond yield might very well start to stabilize around 4.5%, maybe 4.75%. But the economy can live with that level. That we had that before the pandemic. And meanwhile, earnings are actually been picking up. Analysts are predicting the margins are starting to go back up. Companies are dealing with the challenges that they're facing. So I've got 4,600 by year end, and I guess I'm a real outlier to the upside, and I see 5,400 next year. A big part of my story is that productivity is making a comeback. And one of the reasons I think that consumers are going to surprise us here once again isn't just that they're going to continue to get jobs, but we have seen since the beginning of the year that wage inflation has been rising faster than price inflation. Real wages have been going up, and there's no way that can happen sustainably without productivity making a comeback. And I think productivity is making a comeback.
Okay, let's talk about inflation itself, and we'll close off here. Anna, what's your take on inflation? Today's core PCE number softened to 3.9%. Headline CPI in the last 2 months have been rising partly or largely in part because of the rising energy costs. Do you think that core inflation, core PCE in particular, which is what the Fed prefers to look at, will continue to soften in the coming months?
Yeah, our view has been for the past 6 months that the labor market statistics is overstating the strength of the labor market. That was why we actually see sharp disinflation and wage growth in the indicators that the Fed focus on. So I do think that there's an underlying disinflation trend that's happening, driven by weakening of the economy. So that said, I also want to talk about the inflation and how it's consistent with equities, for example. So I've seen equity analysts forecasting double-digit earning growth for next year, and Dr. Yardeni mentioned that margins of firms are rising again. So I find that very inconsistent with the disinflation story, because if it's true that inflation is coming back down to 2% target and the Fed doesn't need to do anything anymore or even cut interest rate next year, then corporate margins should not be rising. That is inconsistent with corporate margins rising. And the only way that could square the circle where you have, corporate margins rising while inflation is under control and inflation expectations are anchored is if there's productivity growth, right, exactly as Yardeni said. But that is the question that your listeners will have to decide, whether productivity is about to be kind of like 1995 Alan Greenspan moment where, Alan Greenspan decided that inflation is no longer a threat because productivity is rising. Are we in that moment? Will AI raise productivity of white collars? I haven't seen much evidence of that, to be honest. I feel like it's, on the other hand, with the elevated geopolitical concerns and this nearshoring phenomenon, it actually would be, and also this work from home phenomenon, which is here to stay, I'm actually more pessimistic about its impact on productivity.
Dr. Ed, I'll let you respond to that and your outlook on inflation, please.
Well, look, I think, we've seen that inflation, to a large extent, with the benefit of hindsight, had a lot to do with the pandemic, the shock of the pandemic and the aftershocks. Of course, fiscal and monetary policy contributed to all that because we had excessively stimulative fiscal policy and excessively stimulative monetary policy. We dropped, those helicopter money. The fiscal authorities dropped money into people's checking accounts, and they spent it, some of it on goods. They felt as though they had purchasing power, and then of course the labor market started to improve. And as I said before, the retailers ran out of inventories by probably late 2020 and had to scramble to get more. And so suddenly prices of durable goods absolutely soared, more than anything we saw during the great inflation of the 1970s. And now durable goods are like down 2% on a year-over-year basis. They're doing what they've typically done before the pandemic. They're deflating. Food and energy prices, of course, are harder to get a handle on. They're very volatile. But I as I mentioned before, I think petroleum inflation is peaking here, and I think the same is true for food inflation. So that leaves us with services. if you take out housing, take out shelter from the CPI, you got a two handle on the year-over-year percent change in the CPI. So a lot of the inflation that we still have is related to rent inflation, and we know that's going to come down substantially. So I think it's ironically going to turn out that inflation was a lot more transitory and less persistent than was widely feared. And I do think that productivity is making a comeback. And I think, again, you can do this at home yourself. Just go on the computer and look for average hourly earnings. It's basically a measure of wages in the employment report that comes out every month. And then look around. You could take the CPI divided by the CPI, which is also on there, and just keep kind of track of an index like that. Or you can go on my website and find it. It's open to the public. But real wages have been increasing since the beginning of the year. To me, that's going to be the way I'll be monitoring it month to month. And with regards to profit margins, all I can tell you is industry analysts were very pessimistic about margins last year. And then all of a sudden, lo and behold, they're turning more optimistic. And their expectations turn out to be pretty good forecasters of where the profit margin, well, they're good coincident indicators. It's just available weekly. So, yeah, a big part of my story is, which I call the roaring 2020s, is in fact related to my view that by the end of the decade, we'll look back and conclude that it started out miserably. But it was the roaring 2020s, just the way the 1920s started out miserably and then ended pretty well. I'm not looking for a Great Depression following that and a market crash, but maybe Anna and I will join you again, David, to assess that at the end of the decade or sooner.
Yeah, absolutely. Well, that was a lot of fun. I'll just give you one last closing statement each, 1 minute each. How concerned should the average American be in regards to their employment next year and their real wages? Anna, I'll let you go first.
Yeah. When you look back at the history of recessions, right before the recession, there's a chorus saying that soft landing is the most likely outcome. That happened on the eve of the 2000 to 2001 recession. That happened right before 2007. In fact, 2 months before the 2007 Great Recession, Janet Yellen herself says that the most likely outcome is soft landing. 2 months before the 2007 recession began, PMI manufacturing, it was also turning up again. The recession chorus also happened right before 2020. We don't know if the pandemic had the pandemic not happened, maybe the economy would have slipped into recession then also. So I think there's a reason why there's always a lot of soft landing projections right before a recession, and that's because the Fed is responsible for a recession. And with monetary policy lags, it's unequal across within an economy. And right before the recession hits is when all these other stuff with short lags tend to reaccelerate, which boys hope that maybe the tightening cycle is over, whereas the labor market only adjusts to higher interest rate with a substantial lags just when things are picking up. So I think that's the main reason why I'm still my baseline is still for a recession to happen sooner rather than later.
Dr. Ed, I'll give you the last word. Same question.
Well, I think that there's no such thing as the average individual or average household. Everybody's got different experiences. Some people are making out through this environment with all of its volatility and concerns relatively well, and others are. There's a lot of people living paycheck to paycheck, so it's hard to generalize. But I think to the extent that the people have been hurt by inflation and now getting hurt by high energy prices, I think you have to recall that these things pass, and supply and demand respond to market forces. So I think inflation will moderate. I think we'll continue to have this rolling recession, which means that some people who maybe continue to maybe tied to some of the areas of the economy that are vulnerable, like commercial real estate, may not have a very good time up ahead here. But all in all, No, I know that it's hard to believe this, given kind of some of the media hype about how terrible things are. On balance, real wages are an all-time record high. Employment is at an all-time record high. Maybe I'm just too much of a macroeconomist and looking at the data. Right now, it all looks pretty good. Obviously, if Anna's right, it's not going to look very good, but that's not my forecast.
All right, excellent. Where can we follow your work, Anna? I'll let you go first.
You can, if you have access to a Bloomberg terminal, then you just type in BCO Go, and you will find our insights and our reaction to data releases there. Also, I will be having a article on exactly on this topic we're debating on right now. Next Monday, it will be posted on the Bloomberg.com website. Headline: Soft landing. Why soft landing is less likely than recessions. On Sunday night, around 6 or 7 p.m.
Okay, excellent. And Dr. Ed?
Well, we have actually a research product for individuals, individual investors, individual business folks, just anybody who's interested in the relationship between the economy and the stock market and the bond market. And that's called, it's www.YardeniQuickTakes.com. So it's one word, YardeniQuickTakes.com.
Okay, well, make sure to follow Anna and Dr. Ed in the links in the description down below. Thank you both for a wonderful discussion. I learned a lot. I'm sure the audience has as well. Thank you.
Thank you, Anna. Thank you, David.
Thank you,
All right,
David.
I'll speak to you both again next time, and don't forget to like and subscribe.